NIO stock closed Thursday's session lower, shedding 39 cents or just under 5% to finish the day at $7.46 per share. It was a sharp move after several strong sessions earlier in the week, and it came as investors faced a mix of renewed regulatory concerns, sector pressure, and general profit-taking near resistance. But as we've seen before with NIO, days like this often end up being pauses rather than reversals, the kind of reset that tests conviction and shakes out weak hands before the next move higher. The decline didn't appear to be triggered by any one dramatic headline, but several overlapping factors likely contributed to the weakness. One of those is the renewed focus on China's export permit policy for electric vehicles. Earlier this month, Beijing confirmed that beginning in 2026, Chinese automakers will be required to obtain government permits before exporting electric vehicles overseas. The stated goal of the policy is to protect the reputation of Chinese brands abroad by ensuring high-quality manufacturing and compliance with safety and environmental standards. Initially, the announcement rattled investors, and while markets had seemed to digest it over the past week, Thursday's weakness suggests that it's still weighing on sentiment. For companies like NIO, which rely on international expansion as part of their growth strategy, any potential restrictions on exports raise questions about future flexibility. That said, many analysts have pointed out that the policy may actually end up benefiting premium automakers such as NIO. By filtering out lower-quality competitors, it could reduce price undercutting and improve brand positioning for manufacturers that already meet high standards. So while the news continues to create short-term caution, the long-term implications could still prove positive. Investors may just be using this uncertainty as an excuse to take profits after the stock's recent rally. Profit-taking was likely another major driver behind Thursday's move. NIO has been trading in a well-defined range between $7 and $8, with strong support forming around 7 even and repeated resistance appearing near 8. Earlier this week, the stock made another run toward that ceiling, touching as high as $7.85 on Wednesday. After such a sharp rebound, it's not uncommon for traders to lock in gains, especially in a volatile market. The pullback to $7.46 represents a retracement within that range, not a breakdown of the trend. As long as the stock holds above the $7 floor, the technical picture remains constructive. The broader electric vehicle sector also faced some pressure today. Reports out of China suggested that several domestic automakers, including BYD, have been cutting prices to maintain market share in the face of fierce competition. That has reignited concerns about margin compression and a potential price war scenario that could hurt profitability across the industry. Whenever that narrative re-emerges, it tends to weigh on all Chinese EV names, even those like NIO that operate at the premium end of the market. In short, sentiment toward the sector turned cautious today, and NIO got caught in that downdraft. Meanwhile, the macro backdrop offered little help. US markets were mixed to lower, with investors reacting to higher bond yields and hawkish comments from Federal Reserve officials. In risk-off sessions like this, growth stocks and international equities often take the brunt of selling pressure. For NIO, which already carries both growth exposure and China exposure, the combination can create exaggerated moves even without company-specific news. Thursday's nearly 5% drop fits that pattern, a relatively normal reaction when sentiment turns defensive. The key point is that nothing material about NIO's fundamentals changed today. The company is still coming off record deliveries, with 34,749 vehicles sold in September and 87,071 in the third quarter, up more than 40% year-over-year. Those are strong results that demonstrate ongoing demand in a competitive market. Analysts continue to take note, with UBS and others maintaining bullish targets around $8.50 per share. Short interest has also continued to decline, down more than 5% in September to around 9.8% of the float. That means there's less bearish speculation working against the stock, and price action may increasingly reflect fundamental buying rather than short-term trading pressure. The technical structure remains clear. Support around 7 to 720 has held through multiple tests, while the upper resistance at $7.80 to $8 remains the zone to break. Thursday's move pulled the stock back toward the midpoint of that range. It's a normal ebb and flow for a stock that's been consolidating for months. If you zoom out on the chart, you'll see a series of higher lows forming since early September. That ascending pattern still indicates accumulation by longer-term investors. The key will be whether NIO can stabilize above 730 and rebuild momentum heading into next week. If it can, today's dip will likely be remembered as just another reset along the way. There's also a psychological element to what happened today. After several strong sessions, many traders may have been anticipating a breakout above $8. When that move didn't happen quickly, some of those short-term players probably lost patience and sold. That's a common dynamic near resistance levels, especially in stocks that have been trending sideways for a while. But for investors with a longer-term view, these shakeouts can present opportunities. When the crowd pulls back, disciplined buyers can step in at more attractive prices. The bigger picture remains supportive. The global electric vehicle market continues to expand, and despite macroeconomic volatility, demand is holding up across major regions. Tesla's record deliveries last quarter underscore that the shift to EVs is real and accelerating. For NIO, this creates a rising tide that helps all credible players in the space. The company's focus on technology, design, and infrastructure, including its growing battery swap network, continues to differentiate it from mass-market competitors. In the long run, those factors matter more than day-to-day price swings. There's also reason to think the export permit overhang will fade over time. The Chinese government has emphasized quality control and international reputation as key objectives, not limitations on successful exporters. For NIO, which already sells in Europe and has established regulatory relationships abroad, compliance shouldn't be a major hurdle. In fact, when the system goes into effect, it could actually help NIO capture a larger share of the premium export market by sidelining lower-end brands that struggle to meet the new standards. So while today's headlines may sound negative, the underlying story hasn't changed. The fundamentals remain intact, sentiment is still improving compared to earlier in the year, and the stock continues to trade within a constructive pattern. If anything, this pullback helps cool off some of the speculative enthusiasm and resets expectations ahead of the next catalyst, likely the upcoming delivery report or new guidance on international expansion. For traders, the levels to watch are clear. The 720 area is immediate support. If that holds, a rebound toward $7.70 or $8 could come quickly. If it breaks, the next zone to test would be around 7 even, where buyers have repeatedly stepped in. On the upside, a clean break above $8 on strong volume could trigger a wave of momentum buying and confirm that the consolidation phase is ending. Until then, patience and discipline are key. For long-term investors, today's weakness is more of a buying opportunity than a warning sign. The company's operational metrics are improving, short interest is falling, and its strategic focus on premium markets gives it resilience against price war dynamics. NIO continues to invest in battery technology, autonomous driving, and energy infrastructure, areas that position it well for the future of mobility. Those are the ingredients of a company that can survive industry consolidation and thrive in the next growth cycle. The takeaway from Thursday's session is that volatility remains part of the journey, but the trajectory is still positive. The pullback to 746 may feel sharp, but it fits within the same uptrend that's been forming since early autumn. Investors who understand that context will see today's move not as a sign of weakness, but as part of the normal rhythm of a stock that's building a base. The fundamentals, technicals, and sentiment are still aligned in a cautiously bullish direction. What matters now is how NIO behaves around support in the coming days. So while headlines might read that NIO fell 5% today, the real story is that it's holding its ground within an upward-sloping base, preparing for its next test of resistance. It's a reminder that in the stock market, short-term noise often masks long-term opportunity. And for NIO, that opportunity still appears very much alive.